You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Buck here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is multifamily syndicator Michael Becker. Now, Michael is a principal at SPI Advisory LLC and heads SPI's Dallas, Texas office, where he oversees all aspects of property operations, including asset management, property management oversight, accounting and taxation, capital improvement and renovation projects, and investor relations. Michael is a 15-year veteran commercial real estate banker and has originated and managed numerous portfolios of permanent and bridge loans in all major asset classes. And in this interview, Michael and I are going to be particularly focused on how multifamily has performed over these last 2 months during the pandemic. But more specifically, we're going to talk about the proactive measures that his team took as we entered into the crisis. Things such as communication with residents, communications with investors, what have you. We're also going to talk about what the collections in May looked like versus April, including how Class A, B, and C apartments performed comparatively speaking. We're going to talk about what type of leasing activity he had over the last 2 months. We're going to talk about what are some of the long-term behavioral changes that he sees playing out, and how will these changes affect the multifamily space as we know it today? Things such as common area uses, fitness facilities, clubhouses, what have you. One of the other things we're going to touch on is, moving forward, does he feel that developers will place less of an emphasis on these different social amenities? Again, the common areas and the clubhouses and the pools, what have you. We're also going to discuss the potential opportunity of repurposing prime located hotels into multifamily. As we all know, the hospitality industry is probably the asset class that has taken the biggest bloodbath in the commercial real estate field. And so I'm of the opinion that there will be huge opportunities in distressed hotels that are in prime locations that ultimately could be converted into multifamily properties. And so, guys, without further ado, let's get on to that part of the show that you always are waiting for, which is our interview with Michael Becker. So here we go. Hey guys, it's my honor to introduce my guest for today's show, multifamily syndicator and principal at SPI Advisory, Michael Becker. Michael, how you doing today, buddy?
Kevin, doing well. Appreciate you having me on.
Yeah, appreciate you being here, and very excited for the call today, and just to really dig into these last 2 months. Right, this is going to be an episode very specific to the COVID-19 pandemic, and how that has affected multifamily, but more specifically, you've got a fairly large portfolio, so we're going to talk to how you've seen the trends kind of playing out in your multifamily portfolio there in the Texas market. And so, real quick, Michael, before we get rolling and dive into it, for those folks that might not be familiar with you, maybe just take a few minutes to give a brief background of yourself and what you do in the real estate space.
Sure. So I'm Michael Becker, based in Dallas, Texas. I'm a principal of a company called SPI Advisory. So we own about 6,000 units today. We've done about 10,000 units this last cycle, but today we own about 6,000 units spread between three markets in Texas, a handful of deals in a small secondary market about 2 hours east of Dallas called Tyler. Own some assets down in the Austin market. The majority of our portfolio is up in Dallas-Fort Worth, which is where I'm based. And we kind of started out doing a lot of workforce housing, kind of the early part of the cycle, this last cycle. Then over the cycle, we took the opportunity to kind of sell old, buy new, and trade up in quality. So the majority of what we own is kind of that A- to A, but we still kind of own a little bit of C, a little bit of B, and some A. So kind of have a little bit of diversity within the grade of the properties that we own. But they're all based in Dallas-Fort Worth and the Texas markets I just mentioned.
Okay, fantastic. And yeah, that's one of the things that we're definitely going to touch on here today is being that you still own some of that C-class stuff, you've got B and some A, you kind of run the spectrum. And I'm sure that the performance over the last 2 months, as far as collections are concerned, I'm sure it's varied a little bit between those different classes. So that's one thing that we're going to touch on here. But I'd like to hit the rewind button and back up a little bit, and depending on what part of the country you're in, we've kind of been in this thing now for 2 months or more. And so I'm going to back up till let's call it March, right? March is really the the month where things started really going haywire here in the States, and certain areas started putting lockdowns in place and stay-at-home orders, and or at least we knew we were on the cusp of that, right? Depending on where you were, some states were later in that cycle, but the conversations being landlords and owner of rental property, those conversations internally started happening in March as to, we need to start communicating with our residents, need to have, be proactive with this, and so that we can, hopefully stave off any potential issues, related to loss of jobs, be there to work with the residents, what have you. And so I love to talk about your approach. What approach your team took to, again, proactively communicate during the month of March as it relates to the pandemic, and what did that communication cycle look like?
Yeah, there's really kind of two sides of it. One was kind of the on-site operational side. The other's kind of the investor side, capital side. So on the on-site, the first thing we did is we shut down our offices. Was one of the first things we did, and our amenity set. So the pools, the gyms, all that was kind of closed to the public. Our offices were shut to the public, even though the staff was still there working. We just kind of moved to a virtual leasing strategy. We had to lease either online, or then ultimately we kind of transitioned and added like a lockbox, like a realtor style lockbox to the model unit, so you can go tour it unattended, one off at a time. And then we turned off, all the non-emergency work orders were turned off as well. So we're trying to limit the contact between the staff and the tenants and the inside the units in particular, because that was a concern. Then on the capital side, we turned off all capital projects. So anything that wasn't already kind of well underway, we decided to kind of put on hold. We had a couple buildings where we were going to do some carpentry and paint work on the exterior. So we kind of hit the pause button on those and stopped doing unit upgrades. And then to the investors, we communicated that, hey, we're going to turn off distribution. So we're a company that typically pays monthly. So until we kind of get some sort of clarity of the situation, we wanted to make sure we kind of conserve cash. And that's kind of what the first thing we did. And now here we are, a couple months past that, we're turning back on non-emergency work orders as we speak. Yep. So those are kind of getting turned back on. I think in the next week or two, we'll open up the office to the public again. So we're kind of getting on the backside of all this. But that's kind of what we've been doing. And then on an ongoing basis, really, communication was key. In particular, we're with our investors. So we'll have a couple times a week, I'm sending out updates on collections. Really, that's kind of the most key metric. Getting dollars in the door. That's what everyone is concerned about. So I've been kind of trying to over communicate that with the investors so they kind of understand what's going on. And then a couple times a week, we're having conversation with the management company. So we employ a third-party management company. So every Tuesday, every Thursday. So I got a call here this afternoon with them to kind of get just a general status update on what's going on the ground.
Yeah, fantastic. I appreciate that. And I was going to ask a question if you guys self-manage or outsource a third-party management company. And so, looking back, is there anything that, not necessarily that you'd have done differently, is there anything that maybe you wanted to do or would have done, but maybe it just didn't play out, given the fact that you got a little bit of an intermediary there with the third-party management company?
No, I think they did a pretty good job. We kind of got out of their way, and they had a plan. And if I was trying to interject myself in every little decision, it would just have slowed them down, to be honest with you. So we employ them for a reason, and I think they're proving their weight at this moment in time.
Did you guys have any outbreaks in any of the communities that you operate?
So we have two properties that have elevator, like interior corridors and elevators in them. All the rest are garden style. So yeah, we have had cases, but no, I wouldn't call it like an outbreak, but a resident here, resident there type of thing. Luckily, we don't have a lot of high density interior corridor or high rise type buildings like you might have in New York City or San Francisco. We're all relatively garden style, suburban, 3-story walk up type product.
Got it. Moving on here, let's talk about the collections, right? That if anyone lost sleep being a landlord, it was really probably first in the month of March leading up to the month of April, right? As to what was really going to happen, right? Setting expectations appropriately, probably setting them fairly low, and then hoping that they were exceeded. And then once April kind of played out, the new news became, May. May is going to be the worst month, right? And
Sure.
There's these collective groups across the country that were talking about, uniting together and doing rent strikes, what have you. I'm sure that probably did play out in a few areas. I'm hoping that you were not affected by those. I don't think that you were. And so, but I love to hear some or have you share some of the statistics regarding collections in April versus May. Again, we're 2 weeks now, a little bit more than 2 weeks into May, and so I think that's probably a good barometer as to how the remainder of the month's going to play out. And so if you wouldn't mind sharing that, I'd love to hear.
Yeah, so like you mentioned, kind of late March was like, oh my God, what's going to happen in April? Because March is relatively unaffected from a collection standpoint. So on a typical month, we're somewhere south of 1% delinquency. So we're collecting 99+% of the scheduled rents on a monthly basis, portfolio wide. So we kind of, I don't know, Kevin, my mind went to probably 50% or 25% delinquency. I mean, some crazy numbers were going through my head as we're kind of ending in April. Well, it turned out to be much better for us. And I think as industry as a whole, we collected 97.5% of scheduled rent. So, probably 4 times the normal delinquency, 3 to 4 times normal delinquency, but all things considered, that's pretty darn good. Now it kind of was dispersed and trickled throughout the month because we can't charge late fees now and people got on payment plans. But at the end of the day, 97.5% was a big success. And then, of course, at the end of April, what's May going to be? Well, May is actually outpacing this time in April slightly. Yes. So we're generally on the same track, if not slightly better, in most of our properties. So as of this morning, we're the 14th of May as we record this, about 95% collected. So, we're a little bit ahead of the same period for April. So, I mean, I was thinking that we are going to probably close out +/-4. If I finished last month at 2.5% delinquency, I was thinking this month to be kind of +/-4%, like a slight deterioration. I don't know. We might be right back around that 97.5% range. We kind of 4% ± was where I thought we'd be. And then June, we'll start talking about June here. I don't know what's going to happen in June, but it seems like the stimulus money.
Well, Texas had their act together with the unemployment insurance, right? I mean, some of the states are just literally still struggling, like Pennsylvania, where I was born and raised. I don't have any property there, but I kind of follow it because I've got family up there still, and they're still fumbling it. And Florida was another state that fumbled the unemployment insurance, and some folks still haven't received it. The majority have now, but New York was another one, right? New York is, which is interesting because you would think that Cuomo is basically, the president of the United States because he's probably getting more airtime than Trump is himself, right? And New York is really the front line, but they have fumbled their unemployment worse than probably any other state. And they're probably the one state that needs it more than any other state, as far as the residents are concerned. And, I think that most states have gotten their act together. And again, I'm assuming Texas probably has as well.
Yeah, I think, economics and stuff like that's all relative. So I think relative to everybody else, we did pretty well. I'm sure it could have been better, but because we're trying to put, years worth of unemployment claims all condensed in, a matter of 1 month. I mean, these systems just weren't built for that. Right. So, but I mean, that money's kind of helped. I bet you June will probably hold up pretty well. And then it seems like they're going to pass a further stimulus, which will then probably further support this. I've heard rumblings of having some sort of expansion to a national rental assistance program, sort of an expansion of maybe a national Section 8. Obviously, that'd be very welcome for guys like you and me to be selfish about it, because I think that will really support our income getting paid and down the line. So, I think this won't be quite as bad. I mean, we can talk later about the long-term effects of all these policies and the trillions of dollars. That's the other side of the coin, I guess, and we'll see how that plays out.
Yeah, one of my bigger fears, and I guess it probably more pertains to the B- C class spaces. There's a number of our residents, and we kind of run the gamut as well. We've got A class, we've got some B and some C. Again, it's not really measured that way in mobile home parks. It's more 1 to 5 stars, with 1 star being the lowest quality and 5 star being the nicest. And so our portfolio range is somewhere between a 2.5 star to a 4, maybe 4.5 star community. And the biggest fear I have is in the the lower end communities. A lot of those folks that are unemployed are actually making more money on unemployment now than what they were working. And so you somewhat de-incentivize folks to actually get back into the workforce. And so I'm not sure exactly how that plays out. Obviously, it's going to be on a state-by-state basis as far as how long the unemployment insurance will stay put, what have you. But it'd be interesting to see how things trend out here as we move forward towards the remainder of the year. But in any event, I love speaking to the the different demographics that exist in these, different classes of assets. Did you notice any trends associated with, collections were better in the A class versus the C class, or vice versa?
Yeah, it's kind of what I would have expected going into it. Generally speaking, the nicer the asset, the better it collected. The lower on the property grade, the worse or the higher the delinquency was. So that 2.5% I kind of mentioned, generally speaking, the workforce housing, the C stuff was on the higher end of that range, and the AA minus was on the lower end of the delinquency range. So it did a little bit better. So that's kind of what it and that makes sense to me, because if you think demographically, the people that live at a 1970s C-class deal in Texas tend to have a job that they physically have to be somewhere to do. They serve you your Starbucks, they clean your house, something along those lines, where if you, have a more of a white collar job, you can work from home like I am now from my laptop. So I think those people's incomes were less interrupted.
Isn't that the opposite theme that has historically been pitched in multifamily investing, though? I mean, again, we're not in the multifamily space. We kind of are, I guess you could say, but not in the apartment space. But it seems as though a lot of professionals over the last decade or so have always pitched, A class is the first to get impacted, and the B and C class, the trickle down effect happens, right? Sure. And so it sounds like that has been debunked.
Yeah, I think there's, and then maybe it's the source of it, right? We're in a different era those last 10 years with guys like you and I having podcasts and being on YouTube and being real loud out in the marketplace, where we didn't have a voice before, where I think, historically, you go back to like the 1960s. These REITs, these big life insurance companies wouldn't loan on multi-housing because they thought it was risky. They was only loan on office. And then that kind of evolved. And then, this last decade, it was, workforce housing. And it's, kind of recession resistant or recession proof. You hear words like that thrown around. And, and then I think what really didn't make sense to me, this meticulous, like 2 to 3 years with the cap rates of all this stuff, as more and more capital flowed into the multifamily space, especially through guys like us that go out and raise money, or syndicators similar to us. Everyone started going to the workforce housing. So the cap rates that used to have a pretty decent spread between the top of the market and the bottom of the market, used to be 200-300 basis points in Dallas between a Class A cap rate and a Class C cap rate. Everything compressed, and they were probably within 100 basis points or 1% of each other. Wow. So it didn't make sense to me to pay the same or similar cap rate for something built in 1974 that I could for something built in 2004 or 2014. So we took the opportunity to kind of trade up, because a 5 cap's a 5 cap. And I don't think the marketplace perceived the risk, because, a lot of these guys that were investing just weren't investing prior, or weren't professionally in the business prior to 2010. And, they didn't live through some of the battle scars that those were like kind of in the industry saw the real risk of it. So I think, now we're going to come on the backside of it. I think these cap rates will all kind of generally go up a little bit, at least in the interim. But I'm of the camp that I don't think we're going to see long-term cap rate expansion in any meaningful way for kind of the next decade or so, because there's just so much money that was already in the system, and they just are printing trillions upon trillions. So I think it's going to lead to asset price inflation. Relatively speaking, housing and industrial are going to be the outperformers in this, and so the capital that was going to flow to hospitality or retail or office probably disproportionately will flow back into housing and industrial, further, putting a ceiling on the cap rates and downward pressure on the cap rates. I think we see 2 years, 3 years, 10 years from now.
Yeah, very interesting. And so I wasn't aware that cap rates had gotten within 100 basis points from a class to a C class. That's asinine, because the debt, the quality of debt. I mean, as far as rates concerned, I'm assuming that an A class built within the last decade is going to warrant probably a slightly lower interest rate than that of a C class, right, in the same marketplace.
It did, and then the size of the deal, it was kind of the other side of it is kind of self-fulfilling too, where you have a C-class deal that might be a $10 million loan or $20 million loan, where you buy a brand new Class A deal that might be a $30 or $40 or $50 million loan. These lenders tend to get tighter spreads, the better quality of the deal and the bigger the deal. So, you had those two kind of functions, and as well as they would give more pricing breaks for experienced sponsors. And, usually first-time sponsors aren't going to go buy a $50 million, $60 million multifamily deal. They'll start with something $5 or $10 million. So some combination of all those. And then if you had a bunch of risk to it, like a bunch of value add, these cap rates were even lower and lower, because you had to, kind of pay the seller for some of the upside you're going to go create. So the whole last 2-3 years of the risk risk-adjusted return dynamic in the multifamily space didn't make sense to me from the standpoint that the lower end of the grade was, same or similar cap rates as the upper end of the grade without the perception of, capital risk as well as income. Income wasn't quite as durable on the lower end of the range. These guys had literally no savings. So one little blip in the economy, they can't pay their rent.
Right. No, that's all great. And so I want to talk about the leasing activity. One of the things that we decided collectively to do as a company, and we have our own property management company. So I don't call it self-managed. But we have our own internal property management group that manages our assets. And what we decided to do right at the beginning of April was basically halt any leasing or sales activity. Most of our stuff is sales, but in any event, we stopped all showings. We essentially shut down the office. We weren't even doing remote showings for the first 2 weeks. We kind of just wanted to see how things would play out. We did decide that we were going to ramp it back up after that 2 week span. It took about 3 weeks to really get things back up and rolling. But the one thing that we didn't do, only to gauge ongoing interest, was we never took down our actual advertising. We never stopped marketing on the different venues that we market on. And I was very surprised to see that we didn't see much of a downward trend as far as interest or just general inquiries, right? And in fact, we've in the last 2 months, with the exception of those 3 weeks that we were basically shut down, we've kind of had a record sales month, which was baffling to me. It's just baffling how this is all played out. And so I'd love to hear from your side. I know that you guys didn't necessarily shut down leasing, but you did it on much more of a remote scale. You shut down the office, You did lock boxes, what have you. But did you see much of a downward trend as far as interest in units and overall leasing?
Yeah, I think there's two metrics really. You have traffic, how many showings are you getting, and then you have actual leases. And so for April, our traffic was probably down somewhere between 50 to 60% over kind of same store year over year compared to 2019. But our leasing was actually only down 10 or 15%. So while the traffic was, dramatically impacted, the leasing wasn't as impacted as much. So, what that tells you is the people that were out looking were serious. They weren't any looky-loos. If you were looking for an apartment to lease in April, you were motivated to actually move because you had already put in your notice, you had to move or whatever your situation was. Going to May, we're starting to see the traffic pick back up. It's only 2 weeks into it, so it's a little bit early. It's not that large of a time period, but it's kind of what we have. So traffic is picking up and our conversion ratio is falling relative to where it was in April. So we're getting, more traffic and the conversion ratio is a little bit lower because I think the denominator is getting bigger with the amount of traffic that we're getting. So it's kind of coming back. It is off year over year, but is still relatively robust and holding up a hell of a lot better than I would have anticipated 2 months ago.
Has there been any new technology or systems or processes that you guys have been essentially forced to implement that you feel are going to carry on even after the pandemic has passed? For example, we've been trying to roll out 360, not just walkthroughs for, showings, what have you, like virtual showings, but also even for inspections, for move out inspections, what have you. So that's something that we've been playing with for like the last year, but now we've been really forced to learn it, right? We've been forced to actually train our staff on how to use it. Is there anything along those lines that you guys have basically found value in as being forced by this pandemic to actually implement?
Yeah, I don't know if it's too much new actually technology, but the reliance on it has certainly become much greater with the thank goodness, not that there's ever a good time to have a global pandemic and the entire economy shut down, but thank goodness it happened now versus say 10 years ago, because we do have the virtual tours, we do have the 360 stuff, we do have the ability to fill an application out online. 10 years ago, you'd have to go, like, generally speaking, hand fill it out, a printed paper copy, and then maybe scan and email it back in, but it wasn't all done online. So this has really allowed our industry to maintain that leasing and kind of keep up a little bit better throughout this. So I think it just kind of further relies our reliance on technology is further exacerbated by this. It's just really accelerating the whole process that was already kind of underway. And I think we come out of it, that'll certainly be something that is definitely just part of the life in every multifamily deal across the country, where I'm sure you still have some mom and pop owners that are kind of really getting kicked in the teeth because they just didn't have a good online presence. They didn't have all that stuff because they owned this building for 30 years. That's just how they always done it. This is going to force them to adopt this type of technology, I'm sure.
Either adopt or die, right? So that's where the opportunities lie, right?
That's right. That's right. Yeah, those guys will struggle relative to everybody else. And this economics is all a relative deal. So that's where, potentially some of these opportunities will lie.
You think there's any long-term behavioral changes that will stay in effect? Right now, amenities, a lot of amenities are still closed. Fitness facilities, pools, clubhouses, and even just like you're in Texas, I'm in Florida. We're in two of the states that have been, I wouldn't say they've been lax this entire time, but we've had a little bit more liberties than a lot of the other states have as far as just being able to go out and exercise, and we've had the weather that actually supports that. We've got sunshine and things of that nature. But, just even going out, I went on a bike ride this morning, and we've got a trail that I ride on, and it's just, everyone just avoids each other, and it's just everyone's kind of turning the other way. And so I'm wondering how those types of trends play out in, these are different amenities, the common areas that people typically would attract them to a particular, apartment complex, saying, hey, I love the clubhouse idea. I love that they got this outdoor common area, but will those things be used as much, do you feel, or as desirable moving on?
Yeah, I think the fitness centers obviously will be, I was of the mindset that we always had nice pools, nice offices, nice fitness centers, because that's what kind of the point of leasing is generally done, in the office, right? That's kind of where the decisions made. So you want to have a nice environment for them. And you want these people to envision they can work out at this gym versus their 24-hour gym membership they have. But at the end of the day, I'm not sure anyone uses any of this crap anyways, really, on a large scale, because, America's getting fatter by the year, seemingly. So I don't think they're really in the gym all that often. But I think that's really going to lessen the reliance on that. It's probably going to shift too. If you think about it, the last decade, a lot of the headlines in my industry has been about taking the reurbanization of a lot of this stuff. So people going back into the urban cores of these cities and getting these micro units or the sharing economy and, the WeWork. And then you have all these kind of like co-living situations. And I think all that stuff's out the window, right? So that's fallen out. Whew. So I think if you have a bunch of, 450, 500 square foot, tiny efficiency, one bedroom type units, people are going to spend more and more time inside their unit. So I think having maybe these larger floor plans that we used to have might come back in vogue a little bit, because you're going to maybe work from home or spend more time inside your home, at least for the next several years. I would imagine that'd be something that this isn't going to be a memory we all forget immediately. This will take into life. And then maybe some of the co-working stuff, maybe you have some sort of element of that in your amenity set, so people could maybe get out of the unit, even though they're not going to go to an office. Maybe they go to the clubhouse and kind of work at some sort of area within there. So maybe something along those lines might be what I expect to maybe kind of be a little bit more desirable from a tenant standpoint.
Yeah, no, agreed. How about you guys, as far as a company, moving forward? Are you looking at opportunities today? If so, how have you adjusted your underwriting to accommodate these, again, just kind of uncertain times that we find ourselves in?
I mean, we're trying. This is a whole lot of. It's kind of like a Seinfeld episode. It's a whole lot about nothing, right? There's not much going on right now. The lenders are going to offer forbearance for the people in trouble. So, generally speaking, what's happening is, those of us that had, well-occupied deals that didn't have distress before, or just as I mentioned, we collected, almost 98% of scheduled rents, and we're, on pace to do that again in May. So we honestly don't really have any economic distress. So those that had some stress going into this is probably going to further exacerbate those situations. So, really, I think the opportunity as we come will really be kind of like, I think of a barbell analogy. It's going to be the bottom of the market. So, the real tough deals in a high crime area that were undercapitalized, didn't have proper management in place, had some sort of distress going into this, and probably have an inexperienced sponsor. They're going to have issues, right? And then conversely, on the other end of the range, a brand new Class A deal that's delivered 6 months ago maybe is 25, 30% occupied on this initial lease up. Those lease ups are going to be slow. Their concessions are going to be larger than they pro forma. Their rental rates will probably be lower than they pro forma, and they're on a construction loan. So they're going to have some sort of maturity coming up. And so I think that's really where those two sides of the thing. I think if you're somewhere in the middle, well capitalized, have a good physical asset, proper management in place, and you didn't have, ongoing operational stress going into this, you'll probably ride this out okay. And so I think it's probably fourth quarter, we'll see the first couple of those deals really start kind of going through the system, and really 2021 will be when it clears, because the lenders are going to give these guys some lifeline for the next several months to kind of get through it. So, but yeah, we're trying to be aggressive, because I'm in the camp that long term, I don't think cap rates move anywhere up in the long term. I think they stay where they're at or go down because, I mean, you think about it, really it's a function of, returns relative to, other assets. So we're going to have 0% interest rates or, so we're going to be able to borrow extremely cheap, which will keep support for keeping cap rates low. There was already a ton of interest in the capital. And then, like I mentioned, the capital that was allocated to commercial real estate, I think will be more allocated to the winners, which is going to be multifamily and industrial. So I think those two sectors will outperform, or generally housing, right? And that'd be manufactured housing or the single family rental programs that were popularized about a decade ago. I think those will also be winners as well. And then, with the amount of capital that was already there, we're already put $2-3 trillion, and they're talking about another $3 trillion bill. And this is only 2 months into this. So, our national debt went from 24 to 25 trillion in the month of April. And then, I mean, I don't see how we don't have a $50 trillion dollar deficit or national debt in 6 years, 5 years, 6 years, 7 years, something like that. I mean, that sounds insane to have those words come out of my mouth, but I mean,
it's insane.
That's probably what's going to happen. And then when that happens, I think, we're eventually, we haven't seen any consumer price inflation, but I mean, we're going to start seeing supply shocks. So there's demand is down right now, which is causing some consumer price to index CPI to go down. I think it was down 0.8 for the month of April. And then I think we'll see that for a little bit. But at some point where there's all this money floating around and then we're going to have all these supply shocks, we're taking the supply chain from China and put it in America where there's like labor unions and more overhead. I mean, we're going to start having to see, I think we're seeing some sort of level of consumer price inflation, but I do feel very confident. I don't know if I can guarantee anything, but again, I don't see any world that we don't see massive asset price inflation. So if you get ahead of this, you get in commercial real estate, a tangible asset with debt that is fixed, and then your debt's fixed and these prices skyrocket, I don't see how you don't make a fortune in the next 5 years, 10 years, if you can position yourself, take advantage of some of these opportunities.
Well, that's great advice. I was going to ask you, what type of advice would you give a new syndicator getting to the space? But I think that you just nailed it right there. I mean, at least that's a good component of it, right?
Yeah, I think if you haven't done this before, certainly get networked. You need to build these relationships now. Honestly, now's probably a better time than almost any because these brokers don't have anything to do, so they'll take your phone call maybe a little bit more readily than these guys. Maybe got a little bit of cocky last couple years because there was so much demand. If I didn't want to buy it, there was a line to the left of me that was standing there to buy these assets at ever increasing prices, and now all that's kind of gone away. So I think you have a good opportunity. Build these relationships. That's what I'm trying to do. I'm trying to stay relevant. We don't really have a lot to talk about besides kind of, I collected another $100 today on this property. There's not a whole lot going on from that standpoint, but I want to be there because there's going to be a moment where I'm going to hear like, oh, this deal, my competitor bought this deal at this price. So it's going to be like, oh, that's interesting. This price got reset. And that's going to be the moment for me that's going to be like, okay, it's go time. And that moment hasn't happened yet, but I expect it to happen. If I'm not constantly having these conversations, constantly staying relevant, I'm going to be late to the game. I want to be one of the first movers to kind of take advantage of this whenever that little moment happens, and whatever form it looks like, I'm not quite sure. Agreed.
And do you guys intend to stay in the Texas market? Is that where your core is going to remain?
I think we'll eventually probably expand at some point, but right now we got to Austin, about 2 years ago, we bought our first deal. So we're about 1,500 units down to Austin. We really want to was hoping to finish the year at about over 2,000 units down there. And so those are going to be the two focuses kind of at least early. I mean, at some point, San Antonio, I'm trying to stay with San Antonio and Houston, but those kind of make sense at some point for us. But, I honestly, the, great economic migration we've been seeing over the last 20 years is can continue to happen, and it's really been from the Northeast and the West Coast, and these jobs, and then people follow the jobs have been going from York and going to Florida, or going from Chicago to Texas, or California to Texas, Arizona, and Nevada. So I think these things are going to continue to exacerbate themselves. This crisis will accelerate what already has been happening. And, you saw all the headlines here recently about Elon Musk and Tesla in California. And I mean, that's, but maybe that's not that big a deal on its own, but it's a signal to the rest of the business community that you are patently insane to try to operate a manufacturing business in the state of California. So why the hell would you want to do that? And when, the elected officials tell you to go F off, I mean, that's crazy. Right. So I think there'll be disproportionate winners. And if you get in Arizona, Florida, Texas, Nevada, Utah, places like that, I think you're going to have the winds in your sail. So, if we do expand outside of here, I like the Phoenix markets. I like a lot of Florida markets as well. But, just trying to make sure we when you go further away from what your risk goes up because you don't know everything you need to know. So your likelihood of making a mistake goes up. So we just want to be slow and measured in the way we do it.
Mm-hmm.
In Dallas, we have about 800,000 market rate apartment units. In Austin, there's about 200,000 market rate apartment units. So there's about 1 million potential units and growing that we have, potentially to go out and target. So for a group of our size, that's a pretty good pond to go fishing in.
I'd say that. Absolutely. Michael, you shared a lot of great information with us here today. And what I'd like to ask of you is, if you had just one final golden nugget of advice or wisdom that you could leave with our listeners that might inspire and motivate them as they progress in their own real estate investing career, what would that one last golden nugget be?
Yeah, like I said, I think these are, all these people have been waiting, thinking real estate's been overpriced. Well, your opportunity is about to come. I just don't think it's going to be as long of a window as we had the last downturn. Really, you could have bought anywhere from 2009 through 2014, probably 4 or 5 year period. And then before the prices really started accelerating. Not saying they didn't bounce off the bottom, but this time I just don't think it's going to be quite as large of a window because the governmental response has been dramatic and quick. So they're committed to inflate their way out of this. And so I think when you start getting these opportunities, you need to get on it sooner than later. So I don't think you need to let moss grow under your feet. I don't say the time to go is right now, but when it starts going, it's going to go and it's going to go quick. And I think, like I said, I think there'll be winners and losers in this. And not saying there's not a great opportunity. There's probably even greater opportunity in the retail space ultimately when this goes down because it's going to be absolutely decimated. But it's a completely different animal. So
that is a different animal. Yeah,
you better know what you're doing, and but specific education eliminates a lot of risk. So getting educated, getting networked, kind of the basics of these deals. I think if you spend this time now getting educated and getting networked in the field that you want to go play in, those will be things that will be very, very valuable here in the not too distant future.
Well, just looking at the numbers in the the CMBS loans that are already in special servicing, right? Most of it's made up of retail and hospitality. It's absolute bloodbath in those two arenas. And there was a conversation I was having the other day with I think it was last week with the CEO of Hotel Equities, and they're one of the larger hotel operators in the country. And just talking to him about their performance, it's abysmal. It's horrible. I think their occupancy was about 7%. In comparison to the same time, last year, which was like 87%, right? And so it's just horrific across the board. And, what they're going to do with a lot of the, spaces such as ballroom spaces, right? It's a big revenue line item on their P&L. And what do you do moving forward with that space when it makes up maybe even, a quarter of the square footage of your hotel, is entertainment space like that. And, and I think there could be opportunities, generally speaking, in the hospitality space for those that are, want to get in and, in a prime located hotel and get in and convert it potentially to multifamily. I've got a good friend that actually has done it many times in Manhattan, which is a very unique market in and of itself, but has had a great success over the last decade, actually converting hotels and actually even an office building into prime located multifamily spaces. So I think that those that are willing to, take action when that time comes and also be willing to think outside the box, right? I think the ones that are willing to think outside the box and get creative are the ones that are ultimately going to thrive during these next couple of years when that go time comes. And so it's going to be interesting to see, buddy, how this all plays out. And I'm glad to hear that you guys are doing really well and also hopefully, wish that you guys will continue to do well and find some opportunities here in the coming years. So with that, that's all I have, my friend. And guys, if you want to learn more about Michael and what his team's got going on, you can go visit their website. It's SPIadvisory.com. Again, SPIadvisory.com. And we'll be sure to put that in the show notes. And Michael, always a pleasure, man. I really appreciate you jumping on here with me and looking forward to hopefully catching up with you sometime in the near future.
All right, thanks, Kevin. Appreciate it.
All right, guys, that's all we have for today's show. I really appreciate you tuning in. And until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. You guys take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.